Lovely to have everyone here with us today. We have a great program. I'm so excited to have Rona Loshak here with us to share and start the conversation with us about long-term planning. It is near and dear to my heart. It is a personal conversation I am actually having with my own parents, my mom right now. It's really important. And the question is, what do I do for us, right? So we need to learn this. When is the right time? And it seems like now is the right time. How to protect ourselves for our future and not be a burden to our family and plan for that. So this is such a great conversation, and we're going to kick it off with the first in our three-part series. We're right at the top of the hour. We'll continue to let everyone in, but let's get started. Rona, I turn it over to you. Just some logistics before you start is we are recording this, so it will be available and we will be sending it to everyone. It'll be also featured on the savvyladies.org website. We'll be taking questions at the end, so please put them into the chat as you think about them, and we'll be sharing them with Rona for her to answer them at the end. She'll be speaking for about 35 minutes, and then we'll go to Q&A. Any personal questions you might have, you can always visit our helpline, our free financial helpline. We'll put that link in the chat as well. And we'll be happy to connect you with a planner to answer your financial questions around your long-term planning, financial planning, and the like. So, and also if you can stay on mute during the presentation, I think that is just helpful for everyone to hear. So again, thank you. Welcome everyone. And Rona, I turn it over to you.
Okay, thanks so much, Judy, and thank you all for taking the time today to learn about long-term care planning. This is the first in a three-part series on long-term care planning. We're going to talk a little bit more about an overview, but really about why it is so important now, specifically why we're at this inflection point for long-term care. Just a little bit about myself and my partner, Natalie Karp. We've been in business since 2008, focused solely on long-term care planning. Our unique proposition is that we are truly independent. There's not a carrier out there that we don't work with, not a plan design we don't work with, and we're licensed in all 50 states. Every state has different plans. We have the highest accreditations endorsed by AARP, the AICPA, CLTC, National Association of Divorced Financial Professionals, and many other national organizations. We work with advisors and their clients, directly with their clients or directly with advisors. We've been written up in the Wall Street Journal 6 times for our expertise, and I'm happy to share with you, what's going on in this world and why it's so important, especially for women. So we're really at an inflection point now, given the heightened financial and non-financial consequences of long-term care. Long-term care, if you go to a financial advisor, it used to be kind of at the bottom of the list, used to talk about all these things. Now it really has been making its way up the list slowly by slowly as people have had more experience with it and realize that either they want to have a quality life as they age or they don't want to burden their loved ones. There's a reason why it's really been at an inflection point right now. First of all, Washington State was the first state to institute a payroll tax if you did not purchase long-term care insurance privately. Then we have longevity, which is critical. Family dynamics have changed. Government programs have been cut back. And really, people have realized no matter how much money they have, what the true cost of self-funding is, and that it doesn't pay not to shift the risk. So let's talk about why Washington State created the country's first long-term care plan. I don't want to get into so much of the details of the plan as to the point of the fact that they felt they had to do this. There are 10 other states, New York as one of them, and I'll have the list later, who are planning on doing some sort of plan to incentivize residents to buy private long-term care insurance. Basically, long-term care is expensive and most people do not plan for it. 57% of baby boomers don't realize that long-term care is not covered by Medicare. So they wanted to create a publicly funded insurance program just to create a minimal level, $36,000 per person, which is not a lot. The triggers are very high, higher than long-term care. It's not portable outside of Washington State, but the point is they just wanted a minimum for their residents. it was mandated if you did not purchase long-term care insurance within a 6-month window from March of this year to November 1st of this year, that you had to pay a payroll tax of 0.58%. So this just shows the kind of money that people were outlaying. And this was important because people obviously want to compare and know that they could get much better options with private insurance. So now this tax is in effect, and every state will have probably a different scenario. But what happened when the Washington Care Funds, which is called, went into effect? Thousands and thousands of people inundated the private insurance companies. And what happened was, you don't have to get to detail this, but basically this is the list of all the insurance companies as they pulled out of Washington state. There were thousands and thousands and thousands of applications a day. They could not handle it. They couldn't go through the underwriting, and basically they pulled out. So people who got to it too late did not have any options. People who needed other options due to health did not have options. And really by middle of July, there wasn't a carrier left who was of any significance in Washington state who could insure these people. So if you came into the plan, in August, there was nothing for you. So what we're trying to say to people now, because you're probably not aware of what was going on in Washington state, is this is going to be huge. These are the states that it's coming towards: Arkansas, California, Colorado, Hawaii, Illinois, Missouri, Montana, Oregon, North Carolina, New York, and Utah. It will probably take different forms in every state, but more states are looking at this because they cannot sustain people being on Medicaid as Medicaid is being cut back. So we suggest getting ahead of the curve, looking at your options now, especially if you have health conditions. And also if you're doing, which we'll get into in part 2, a 1035 exchange. What that means, if you're taking your life insurance cash value and transferring it into a long-term care policy, that's something we'll get into, but that takes time. A lot of these things take time. And in many cases, there might not be a 6-month period that you have to get private long-term care insurance. So the key that we're talking about is every state will be different, but why did Washington state do this? Because there are so many things, so many factors that are coming into play now regarding long-term care. First of all, we are all living longer. Once a person reaches age 80, there's an 80% chance they'll need long-term care in their lifetime. So what happens as you age? You're more likely to be living alone, more likely to develop a chronic condition, usually on a reduced income. Women live 5 years longer than men, and are also more likely to get Alzheimer's, have a 10-time greater chance of reaching age 85, and at age 65 are twice as likely to be living alone. This is saying affluent Americans, but basically they're considering affluent here with a household income of 100,000 or more. So due to medical advances and healthier lifestyles, if it's a couple, by 2029, hello, can everyone hear me now? Okay, I don't know. Once they reach age 65, then they are going to have lived to age 95. So what's happening now? How has mortality changed as a result of the following health conditions? Basically, what's happening is the conditions that we were used to seeing where you died early on, breast cancer, heart attack, strokes, those are all decreasing. Where the conditions that would cause you to need long-term care are increasing, such as Alzheimer's, up 145%. What's also happening is you could see is that cognitive decline as we're aging is a very big factor. The Wall Street Journal had a huge article in June 2021, baby boomers' biggest financial risk, cognitive decline. It's nothing we all want to think about, but many of us have experienced it or seen it in our families. And as we age, it's more likely, unfortunately, to be an issue. So many people, I'm here to explain and kind of bring this to the forefront. Getting educated on long-term care is the key, because most people don't realize the problems they can experience without proper planning for long-term care. Long-term care is your largest unfunded risk. You're all building up retirement portfolios, and we think about retirement, but nobody thinks about through retirement, how that could really wipe out your nest egg. And because most people have care at home, they need that nest egg to have a lifestyle, and they need long-term care money coming in to pay for care at a home or any setting. So you can see how it affects cash flow issues. It's a threat to your capital. It means a loss of independence and choice. Many people want to be in the type of facility or home that they want to be in. They don't want to be told they lived a quality life, how they want to be. They don't want to be told later on where they have to go. If there's a divorce or blended family, it really is a huge challenge because everyone's in charge, no one's in charge. And we call, basically, long-term care insurance protects the whole family from a tremendous amount of not just financial issues, but emotional issues as well, if there's a long-term care event with divorced and blended families. It creates wealth transfer conflicts. Many of you were planning on leaving some kind of legacy to children, and then it gets wiped out. And it pressures multi-generational legacy and lifestyle. What that means is that if you don't plan for your long-term care, and your child or a relative has to kick in some money for you to pay for your care, that's affecting their lifestyle and possibly grandchildren or a niece or a nephew's lifestyle that they were planning on. So it's not just about you, it definitely affects other members of the family and that wealth transfer. So again, many people say, oh, just push me off, a mountain, push me into the river, but that's not what's going to happen. It really is a family issue. Family members, even if you don't have children, even if you don't have a spouse, they're not going to let you just do that. They're going to try to find the best way to help you. If you are married, many people say, well, my spouse will watch me. But what's happening is because we're all living into our 90s, your spouses probably are older or frail. Many of them will be deceased and they'll be solo aging. Solo aging is what most women will be doing, either because of divorce or because we are living longer. So what we need is, we don't want to rely on children. So we need to, and if they don't have children, what we need to do is to protect ourselves and our quality of life. We talked about second marriages, but I want to talk about women being a part of this conversation. Savvy Ladies is all about empowering women to become more involved in financial decisions. Long-term care is an absolute must for women to become involved in. One, because it will affect you, because you will mostly be living a long life with life expectancy, and you want to have dignity, independence, quality of life. But two, you need to be involved in this because if you are married, that male, or the other spouse, if you are solo aging, whoever that person is, you might wind up being the caregiver. If they don't have long-term care insurance or some kind of cash flow coming in that they feel comfortable accessing, then you're going to wind up being a caregiver. And what happens when somebody's a caregiver? Caregiving causes healthy caregivers to become unhealthy. And you've probably seen this over and over if you know somebody who's giving care. So it's very important for you to be part of the decision-making process. We also suggest, if you have parents, to get involved in this. We have many professional women whose parents, of the generation, know it's a children's responsibility to take care of their parents. Yet many of these parents were the same parents that put you through college, put you through school, wanted you to be a professional. Well, now the best thing they could do for you is to let you live your life and care for them and love them and, get involved with their doctors, but you don't necessarily have to be the caregiver at this point in your life. That doesn't mean you love them less, but you do not need to be helping them on a day-to-day basis. So we have seen many professional women who don't live near their parents purchase long-term care insurance for their parents, which is something else, to think about, as a woman or a daughter. So we really have to understand the facts about long-term care. I mean, we throw the term around a lot. What is long-term care? Think about it. It's where your medical insurance leaves off. We call it care versus cure. Long-term care insurance is the care that you need for extended care, where your medical insurance or Medicare is really to cure you, the hospital, the doctor visits. So it's long-term care refers to assistance that a person with an illness or condition needs to get through the day. It could be physical or cognitive impairment. So the activities of daily living, in order to trigger a long-term care benefit, you need to trigger and need help with 2 out of the 6 activities of daily living. The activities of daily living are bathing, dressing, transferring, toileting, continence, and eating. Most people, as they age, unless there's a health issue, will need help. That doesn't mean somebody should be in the shower with you, but just standing by to make sure you don't fall. So maybe bathing and dressing, or dressing and transferring. Transferring means from a bed to a chair. Just a little help there. So you need to have help for at least 90 days. It's a condition that would last at least 90 days. That does not mean the insurance will kick in after 90 days. It just means that if you break your arm and it's going to be better in 6 weeks, the policy will not kick in. So it doesn't have to be a permanent condition. You can go on and off long-term care insurance, but it does need to last 90 days. The other way to trigger the benefit is if you need supervision for cognitive impairment. And as we discussed, unfortunately, this is a growing concern. The name of this trigger was written into the 1996 HIPAA legislation. It's called the 7702B Standard Long-Term Care Definition. It's very important to make sure that the policies that you get are 7702B, and we'll get more into detail with this in part 2 of the series, where we're getting really into specifics about the plans. But 7702B is a true long-term care rider, where 101G in many cases is a chronic illness rider, which does not have standard definitions. And in many cases, the condition has to be permanent. In fact, when Washington State did their planning and requirement to buy long-term care insurance, the policy must have a 7702B definition, not a 101G. So where is care provided? Well, it's not a nursing home. No one wants to be in a nursing home. In fact, this 18% of long-term care that is provided in a nursing home, about 95% of that is Medicaid. Most people, 82%, are at home or in the community. Home could mean many different things. It could be a homemaker service, any home setting. It could be physical therapy. You can also have skilled nurses. Independent living is considered your home. A continuing care community is also considered your home, and as you move along, it would pay for the assisted living. Nursing homes are covered, hospice, international coverage for many plans. There's also something in all the plans now called alternative plans of care. What that means is that if there's a new name for something 20 years down the line, it'll also be covered. Long-term care insurance is also portable to any state in the US. So the old plans, the old way that people did long-term care planning was they bought a home care plan or a nursing home plan. That's gone. Almost every plan now is a comprehensive plan covering care wherever it is given. So how much does long-term care cost? It's pretty expensive. In a metro area, it's about $32 an hour. And if you were going to have 24-hour care, that would cost you about $750 a day after taxes, okay? So that really is going to mean reallocating income, and where are people going to come up with that money? But that's an extreme, a 24-hour day. Let's just look at the average care need. This is if you had an 8-hour day. This is in today's dollars. An 8-hour day would cost about $100,000 a year, whether it was home care, assisted living, living in assisted living. Obviously, nursing home is more expensive. But that's really not the paradigm now, but it's about probably closer to $130,000, $140,000 a year. The average time care is needed at home, not in a nursing home is much shorter, but at home is 3 years. So in today's dollars, that cost is about $300,000. $300,000 today for long-term care after taxes coming out of your nest egg. Okay, you could say, okay, I could manage that. Some people could manage that. What about in 15 years? That money is growing to $600,000 a person. In 30 years, it's actually going to be $1.2 million per person on average for long-term care. Those are big numbers, and we tell people to take the numbers very seriously. These numbers, if you know anybody that's actually getting care now, you know these numbers are very real, and the cost of care is growing by 5 to 8% per year. So these are real numbers to think about if you want choice of care later on. So how are we going to pay for this? This is big money. Well, there is no federal long-term care program. Basically, this is what Congress has said: take care of your long-term care needs, because there aren't funds available for a new entitlement program. It wasn't in any of the packages in this administration. They did have there is something in there that is good, is that they are making it easier and better for home care providers to be more professional and to be paid more. So that's good, because we don't want a shortage of home care providers. But there's nothing to do with insurance. Something else from a very well-known elder care attorney in this area: long-term care insurance is a must for baby boomers, since Medicaid will not be there for them. The state plans are very modest. They're really there to build more like a safety net. It would be like retiring just on a minimal Social Security benefit. You're basically getting a lifetime maximum of $36,000 a year. And that's not really going to be much in 10 years, 20 years, 30 years. You can't bring it to another state. There's not enough growth. There's much higher medical triggers, but it is there for a safety net for people, which is, needed in many cases. What about Medicare, Medicare supplements, and health insurance? Will that pay? No, not for extended care. Medicare will approve only up to 100 days of skilled nursing care, with an average approval of 20 to 25 days, where long-term care on average is needed for 3 to 4 years. And for patients with Alzheimer's, the average care need is 6 years or longer. So 20 to 25 days is not going to cut it. And then we talk about Medicaid. This could be a whole presentation, but basically anyone with any assets or income, it actually costs more money to get on Medicaid than it does to not be on Medicaid. There's a tremendous amount of consequences for going on Medicaid. It's so much stricter financials than there ever was. There's longer look back periods for home and facility care than there ever was. The government just doesn't have the money, and they have to be cutting back on this. But more importantly, and this is critical, people forget there are 2 triggers for Medicaid. There's the financial trigger. You had a super attorney who made you poor, however you did that. However, there's the medical trigger, and nobody could change that. Nobody could fix that. The medical triggers are much harder to qualify for due to their higher level of care that is required to qualify. Now you need 3 out of 6 activities of daily living, 4 out of 6. In many states, there's managed Medicaid, which means if there's someone in your community that has 6 out of 6 activities of daily living that they need help with, there's no money left for anybody who has help with 3 out of 6. So it's basically a pool of money that they have to allocate. So you definitely do not want to plan for Medicaid and find out that due to your medical triggers, you can't get the services that you need. So we have long-term care insurance, and then many of you are saying, well, what if I just self-fund? I don't, want to write another check. What if I just self-fund? So I just want to touch briefly on the long-term care insurance options, because we're really going to be getting into the details of those in part 2 of this series. So right now we have our standalone or traditional long-term care plans. Those are the plans that many of you are familiar with, pay as you go on an annual basis in most cases. There are a couple that allow you to have limited pay. Some states have state partnership plans where if you exhaust your pool of money, they allow you to go on, and you might have gone through and you might be in bad shape at this point, allow you to go on Medicaid while protecting some of your money. So it's a state partnership by incentivizing people to buy private long-term care insurance with the promise to be able to go on Medicaid to protect some assets if they ever exhaust their pool of money from their private long-term care insurance plan. Then we have our linked benefit plan, which is basically built on a life insurance chassis. And what that means is that we're solving for a big long-term care benefit, and there might be a smaller death benefit about equal to what you put in premiums. but the leverage is in the long-term care. People like this now. This is the new way to plan for it because people feel there's more flexibility. They don't have that use it or lose it. Then we have life insurance with long-term care or chronic illness rider. You're basically buying a death benefit. And if you need long-term care, you're drawing down that death benefit. And then annuities with a chronic illness rider is the same thing. We're going to be getting into a lot more detail on these in the second series, but I just want to talk about comparing this to self-funding yourself, your care. Let's say you had a standalone plan and we paid $3,000 a year. You didn't feel like writing that check. How long-term care insurance works is, if you look at this third column, we bought a plan, this happens to be a male, that we bought a plan for $250 a day or $7,500 a month for a 5-year multiplier, and it's growing at 3% compound inflation. That's all part of the plan in this premium. So from day one, I have $450,000 tax-free for my long-term care needs. That's how we get to our pool of money, $7,500 a day, $7,500, a month times 12 months in a year times 5 years equals $450,000. That's my initial pool of money. Then that pool of money is going to grow every single year by 3% compound to $812,000 tax-free for my long-term care needs. I paid that $3,000 every year. I claim in 20 years. That's what I'm entitled to. Now, if we instead said, I don't feel like writing that check, and I put that money in the bank, I would have put away $60,000, which at 3% compound would have grown to $91,000, not anywhere near the cost of care. But let's say I had a super investment and it grew at 6% guaranteed over 20 years. Even if I had that $180,000, that's still way short of anything that I would need for long-term care. And if I took that out of the investment or the bank, I would have to pay taxes on it. So the leverage is not there for self-funding. Same thing with the asset care. Some people call this shifting over. You're moving a percentage of your portfolio over to protect your nest egg. Because these are usually paid in a limited pay, in a lump sum or a 10 pay, think about moving over a large amount of money, a large amount of money to protect a lot of money. So let's say you said, I'm going to, instead of doing the hybrid plan, I'm going to put aside $127,000 for my long-term care needs. And I'm going to put that in some kind of investment. In 20 years, if long-term care is needed, that would have grown to $208,000 if I put in something safe, because this is my safe money, into Treasury bill. But let's say I put it into something where I got double that and I was getting guaranteed 5%. So I got $400,000, okay, instead of my $200,000. If I need long-term care, I'm going to have to pay taxes on that $400,000 before I could use it for my long-term care needs. And that $400,000 is not going to be as much as I would need for my long-term care needs later on in 20 years. If I instead moved over $127,000, or I paid in 10 years, $12,000 for 10 years, okay, from day one with a hybrid plan, I would have $540,000 tax-free for my long-term care if something happened to me tomorrow. And in 20 years, this plan has 3% simple inflation. I would have $783,000 tax-free for long-term care. And with the hybrid plan, if I didn't need it, okay, and I died, I would have $187,000 death benefit to my beneficiaries. Or if I changed my mind, I would be able to return my premium. All these plans in every state are different. Some states it's 70% back return of premium. Some states it's 95% back. Every plan is different in every state, but you get the idea. They're all similar to this type of plan. Again, that tax-free benefit is huge. The annual cost of private care today, $82,000, let's say. You would have to pull out $126,000 from a bank account to get to that $82,000. We're $82,000 with long-term care insurance, $82,000 of $82,000. So that's why even people with a lot of money know it doesn't make economic sense not to shift the risk for these high costs to a long-term care insurance company. Self-funding costs more because it triggers income taxes, But then we also have the opportunity cost of pulling out that big money from an account. So if I needed $435,000 for long-term care, let's say, I would have to pull out $580,000. Pulling out that $580,000 is giving me a loss in appreciation of what I could be making with that, $91,000. Okay, so let's just look at that. The cost of care was $435,000. I had to pay income taxes to get to that $435,000 on my $580,000 of $145,000. My lost appreciation in assets was $91,000. So the total cost of care, instead of it being $435,000, wound up being $672,000. So for every dollar's worth of care that I got, I actually paid $1.54 of my own money. Where if I had shifted the risk to an insurance company, this is a premium of $3,200. Okay. My benefit, initial benefit in this case is a 3-year multiplier for $7,500 a month, growing at 3% compound. So my initial pool of money that I'm entitled to is $273,000. I don't like writing that check every year of $3,200. Nobody likes to write a check to an insurance company, but we talked about the odds of needing care as we're aging now. Now my long-term care benefit has grown because of the inflation protection in it to $732,000. In 20 years, I paid premiums of $64,000. Okay, 20 years times 3230. I need care of $435,000. All right, I paid $6,400. Even though I'm entitled to $732,000 and I didn't even use that amount, it still only cost me 15 cents for every dollar's worth of care to pay for my long-term care needs, $64,000 to get $435,000. So it's actually 90% more expensive to self-fund your long-term care needs than to shift the risk to an insurance plan. So who should be having these discussions? Basically, anybody in a state with a payroll tax that's coming soon should be having them before the payroll tax is announced, because you could see how the insurance companies flee those states. They don't want to be inundated with people buying minimum plans just to opt out. Women are the most vulnerable because we live longer and likely to be solo agers. Those who want access to a private pool of money, one choice of care. There was an article in the New York Times this weekend on people who want to be in these beautiful, facilities that they're building. They're used to living in a beautiful apartment building and beautiful homes. Well, these facilities are like being in the best resorts. And the second to last paragraph talks about this one man said, I could not have been here if it wasn't for my long-term care insurance policy. Those who do not want to burden children or whose spouse is older or deceased. As I spoke about, these are people, you've put your kids through college, you did the 529s. You don't want to be burdening your children now that you've put them on that path and now you're going to make them caregivers. Those with blended families, as we said, that really does cause a whole host of issues. Lots of ways to design plans. So we've designed plans where, the second spouse, the benefit goes to the first spouse's children. There's so many ways to do that if you're doing any kind of planning. If you are getting divorced, before you're officially divorced, make sure that you look into this prior to becoming single. There's only 2 categories: married or with a partner, or single. And if you're in that, even if you're legally separated, you could still call yourself married and get that extra discount that married couples get. You have to be reasonably healthy, but that's something that we look at. We do a lot of pre-qualification. Anybody that has family history should be looking at this ASAP. They are looking at family history, and we have people in their 30s coming to us buying policies who have family history. If you have an uninsurable spouse, that spouse will be using up retirement assets. Don't be that guilty spouse that says, no, they can't get it, I don't want it. It's even more important for you to protect yourself. And really anybody age 39 to 85, depending on the state. However, we saw people as young as 23 in Washington state buying life insurance with long-term care riders, and they're set now. So that's, you don't have to wait till you're 39 or in your 30s. So again, if your quality of life is important, lifestyle, family independence, that's really what long-term care is about. We are really at an inflection point now due to longevity and all the factors that I just spoke about coming into play. So now is the time to take action. Don't put it at the bottom of your list. It was always at the bottom of your list. It was sitting, I should have, could have, whatever. This is coming down the pike. And we strongly suggest that you've been thinking about it. If it's something that you even want to get educated on, now is really the time. And be happy to answer any questions now. You could reach out to us. I know you can reach out to Savvy Ladies, and the contact information is also below if you want to, reach us directly. So now I will just take some questions. I see Savvy Ladies. Yes, the PowerPoint will be available for you to review, and yes, it will be there. What should I tell my children who are in their 30s? Well, first of all, I hope that you have it. And if they're in their 30s, if they haven't bought life insurance, that's a good age to buy life insurance with a long-term care rider. If they're possibly looking into life insurance in general, it's very, it's not that expensive for them to do that. Otherwise, if they are in certain states, they can get a long-term care policy. Where should we begin to look for plans? What should we be aware of when looking at these plans? Well, you could call us. So we basically work with there's not a plan out there that we don't work with. And how it starts, and again, we're going to get into this in the second part, is you have to pre-qualify when looking at these plans. So there's so many plans out there, but it becomes really, really narrow when we do an intake form and find out what state you live in, your ages, your marital status, your health, even things such as if you have osteoporosis, things that you're in PT, sometimes there's a weight, what your spouse could do, where you want to retire, how you see this, maybe you want to retire internationally. So you don't go into this looking at everything. You go into this with a really strong pre-qualification. For instance, we do a very, very strong pre-qualification so that when we are applying for something, we know that one, that they're going to accept us because we've pre-qualified with the insurance companies. They're very strict. And two, that it fits our needs and our budget. There's no apples to apples anymore. Every plan is very different. Some plans are cash, some plans are reimbursement, some plans are great for business owners. And again, that's all information that we have to take down before we could look at what plans make sense. How likely will I be to qualify for an LTC plan if I already have health issues? You'd be surprised. Health issues for long-term care are very different than for life insurance. Long-term care companies look at things such as your mobility. And again, that's why osteoporosis is such a big deal. We're having problems with women who are too thin because they're scared they're going to break their bones. I had a client from The Amazing Race who couldn't qualify because he basically was in PT constantly, but no health issues and no medications. So sometimes if you have a health issue, but you're taking, it's resolved, or you've had a waiting period, or you're taking medication for it, it's fine. They look at breast cancer now, fine. They just want to look at the stage, prostate cancer, all that. So once you talk about your conditions, then I could go into specific questions. So we suggest that you contact us and talk about it and see what your options are, because that's the benefit that we have. And I'm not just saying this, but for anybody, that we work with every single company. So every company has different sweet spots for health conditions. So that's why you want to be able to access all of them to see who will accept you. Here's that New York Times article. Thank you so much for sharing that. Yeah, it was a very interesting article. So thank you. What is the average cost for a 57-year-old female in good health living in New Jersey? That is across the board. The hardest thing that you have to do right now is we can make a plan at basically any budget. The hard thing to do is qualifying and making sure we have the plan that fits our needs. So it's also a matter of how much cost you want to co-insure. So for instance, if the cost of care today is about $7,500 a month, or $9,000 a month, let's say. And you were getting a check coming in from the insurance company for $6,000 a month, tax-free. And you had to take $3,000 a month out of your own money. That would certainly help tremendously with your long-term care costs, even if you weren't covering the full amount. So you have to think about that. We can make a plan in any budget. It will still allow you to have flexibility and choice of care, but we have to balance budget for your needs. So we don't, it's very hard to say an average cost. You give us your budget. You know, if you're healthy and you're, you know, in good shape, we could have a plan between 3,000, 2,000 even, and, you know, as high as you want to go. But people in Washington State were getting some minimum plans, you know, for, you know, a couple of $100 a month, you know, less than your cable bill. And you could certainly do that. If I contact you, would you be able to help me if I live in, is that Missouri, Montana, wherever it is, whatever state it's in, it doesn't matter, because yes, we can help you. We're licensed in all 50 states. I'm getting confused with my M's now because we're working with people in Maryland, Missouri, and all over the place. So lots of M things. So I'm sorry if I don't have that offhand. My MO, I think it's Montana. Oh no, Montana must be MT. I don't know, Missouri. We'll figure, whatever it is, I could help you. I have a policy with Genworth. They appear not to be highly rated now. They also doubled my premium. Should I rethink? Absolutely not. You should look at the options that they sent you. You probably bought it many years ago, and you've probably built up a tremendous amount of long-term care benefit at this point. So decide whether you can afford the premium or not, the increase. If not, there's lots of different ways to reduce the premium for yourself. If you are young and you bought it years ago, maybe there's another option that we could look at. But in general, it probably is still an excellent value. You don't have to take the doubled premium. You could reduce the inflation protection. You can reduce the daily benefit. You can increase the elimination period. Lots of different ways. I would give them a call, or whoever you got the policy from, and look at different ways to reduce that premium. If you do want to look at other options, I'd be happy to show you other options. And I think you'll see, you know, if you want to change into maybe one of the hybrid plans that are guaranteed, you could look into that. But I wouldn't give it up totally. You might just want to reduce it a little. What happens if we have a retirement account and pension plan, but everything totals less than 100,000? Well, it depends what's in your retirement account. So you do have to have the money, you know, to be able to afford the premium every year. Many people wait until they have their RMDs, because you're getting that extra money, and that could sometimes help pay the long-term care insurance premium. If you are in certain states, you can also take money out of your retirement account to do that. So we'd really have to look at that depending on the state. But we could also get a modest plan where you're paying on a monthly basis. And if you're young enough, many times you could get a again, some of these shared plans, if you are a couple, they're very affordable and offer a lot of value for not a lot of money. Are you a broker? Yes, we're a broker, and we work with every single company out there. That's what we do. And we take you really from educating you to taking you through the contract, and work with you every year to make sure that you understand what you have, and work with your advisors if you have any, just to make sure that we're all on the same page. And, you know, we every year tell you what the new tax credits and benefits are. And if there's ever a rate increase, you know, we always help you with that. My mom bought decades ago and is now in her 80s. She had to give it up because the dues went up by an extraordinary amount. This industry seems to be unregulated. I've also heard that it's very hard to even get reimbursement for legitimate expenses. Well, She did not have to give up her plan. First of all, you could always bring down your plan to a minimum level. Even if she brought it down, she probably would have had at least $100,000 for her long-term care needs. She was not well advised as far as giving it up, because there's never take the increase or get rid of it. That's never an option. You always have the option to reduce the plan a little, and that's always better than sacrificing it or lapsing it. As far as being unregulated, that's actually in the next part, but that's actually not true. There's probably since the 1980s about 6 laws in effect that when rates are put out there now, that they do have to be permanent and they have to show a good reason. She did buy an older plan. She did get in when the industry was young, before these regulations were in place, but they're certainly in place now, and they have to show a legitimate reason for increasing rates. Most of the new plans now are with mutual companies that don't have to report quarterly earnings to stockholders. So it's basically owned by the policyholders, and they're committed to the long-term care industry. They weren't people that just got in, in the 80s because it was the new hot thing. They're very committed to the industry. It is not hard to get reimbursed for legitimate expenses. What I have found is that many people don't understand their plans. Many people in the 80s bought plans that were either home care or community care, or they were nursing home care. And many people didn't understand their plans. Many of the plans in the 80s didn't cover Alzheimer's. Now they do. Since 1996, all those standard triggers are in place. So many of the older plans did not, as I spoke about the HIPAA legislation. So it is possible that based on the older plan that was written before these regulations were in effect, that there were some issues, but she should not have had to give it up. So that's really a shame. What happens to long-term care policy if and when insurer decides to get out of the LTC business? Happened to my parents. They lost one policy and had to start over again with Johnny Hancock. Which insurers are still in this business? My impression is that so many have gotten out of the business. First of all, if an insurance company doesn't sell long-term care insurance anymore, that doesn't mean they're not servicing it. For instance, I have a MetLife plan. MetLife doesn't sell long-term care insurance anymore, but I call up and there's a MetLife person and it's a great company and they're still servicing, and that has no bearing on it. Just like when you're at a bank and they change their name, it has no bearing on your policy or on the contract. They should not have had to go to a new company. I've never heard of that. If they've had a policy, usually one company buys another company. Okay. So that's really what should have happened. There's many insurance companies, there's at least 20 in the business now. And some of the people who are not committed to the industry, who were doing this as kind of a sidebar, did get out of it. But the people that are in the field now are very committed. They not only have selling insurance, but they have whole offices dedicated to helping clients find the care that they need. They're very there for them. So if you know anybody that's claimed lately, for instance, Genworth, we're just having this conversation. They don't sell long-term care policies anymore, but if you call them, they're there for you. They're there answering. Same thing with Unum. The contracts are the contracts. They're still getting premiums paid, and they're still there for their policyholders. If a company does go out of business, and only 1 or 2 companies have, there is the insurance guarantee fund for every state, similar to FDIC or SIPC. That's for your brokerage accounts. So that's under every long-term care insurance policy. Yes, the phone number is that phone number, 516-801-1419. Is there one thing, or is there a chance you would buy one policy now and then the company changes, or you need to change to another company? It usually does not happen. Usually you're buying it younger and healthier, and it's always best to keep it what you have and then layer it with another policy if you didn't buy enough. I also understand a lot of LTC companies are getting out of the business. What happens to you in this case if it goes out of business? I just talked about the insurance guarantee fund. Most likely a company, Missouri. Okay, I got it. I did think it was Missouri. Thank you. Are LTC policies yearly cost locked in, or does it increase yearly? They are, every plan is different. Some you buy more every year and some are locked in. So again, that depends on your needs. Some younger people like to buy it at a where you buy every year because they want to buy it inexpensive now and they'll have more money later on. Some people want to lock in their rate. Most people want to lock in their rate. I was told I had to wait because I'd recently lost some weight. What type of health is considered good health? That's personal, and we would, speak with you on, on the phone with that. How late can I buy LTC? I'm healthy now. Waiting is never good. Nobody has a crystal ball, but your health could change tomorrow. I've had people call me that I spoke to 5 years ago, and now they're young, 59-year-old woman just diagnosed with MS. It's sad to say somebody else got it in a car accident, and now she's, in physical therapy for a year. And then what happens is companies come out with new policies that are always more expensive because they don't want to go back to older policy holders to raise rates. So not only will you be older, a year older, but you might have health issues, and the companies have increased rates on new plans. And I think that's it for now. And hopefully we'll answer a lot of these questions in 2 weeks.
Yeah, no, Rona, I think this was fantastic. And I think right at the top of the hour, and you answered everyone's question. This was so informative for everyone. And I think it gives everyone on the call really a lot to think about, because I think we're all, as women here, sitting at that juncture, as you said, where we see the longevity and all the points you make, and we need to really start considering what actions to take now. So thank you so much for presenting. Very, very informative. And everyone, we have you. Hopefully you'll sign up for the next 2 sessions. As you've seen, this is so informative and lots of questions and more to come.
Great. Thank you so much, everyone.